Every single Friday, millions of everyday Americans watch a massive percentage of their hard-earned paychecks vanish into thin air. At the same time, the wealthiest people in the country are receiving official letters from the IRS showing they legally owe $0 in federal income tax. Most taxpayers view these complex forms as a financial penalty. However, institutional investors treat the tax code as a completely different game entirely. The Internal Revenue Code is thousands of pages long. Most of these pages contain the exact incentives and legal loopholes designed to stimulate the economy. The system legally rewards individuals who align their finances to provide housing, to create jobs, or invest in the domestic market. Understanding these specific behavioral incentives allows a taxpayer to use the system as a wealth-building accelerator rather than a passive financial drain. The first major incentive involves the government's desire to stimulate business activity through the use of residential space. Under Section 280A, also known as the Augusta Rule, you can rent your primary residence to your own business for up to 14 days per year. Your business claims a legitimate corporate tax deduction for the rental expense, while you receive that cash into your personal bank account entirely tax-free. To maintain compliance, document your meetings and ensure the rate matches local market rates. This strategy enables entrepreneurs to legally transfer thousands of dollars of wealth from their corporate entity directly into their personal accounts. The IRS also incentivizes business owners to restructure their entities so they can retain capital for reinvestment and growth. Sole proprietors face a 15.3% self-employment tax on every dollar they earn, which significantly limits their ability to expand. By restructuring as an S corporation, you split earnings into a reasonable salary and a business distribution. The heavy self-employment tax only applies to the salary. The money in the distribution path remains shielded, keeping more capital inside the business. Changing your entity structure allows you to stop paying unnecessary tax penalties and retain the capital needed for long-term expansion. The government also relies on private investors to supply and maintain domestic housing, and they offer significant tax breaks to those who do. Cost segregation allows property owners to visually dissect a building into components like appliances, flooring, and fixtures. While the IRS requires depreciation over 27.5 years, this strategy accelerates the timeline down to 5 or 15 years. This creates massive paper losses in the first year. Qualified real estate professionals can use these losses to neutralize their active day job income. These high-earning individuals use this method to wipe out their highest tax brackets without losing any actual cash. Combining corporate rental exemptions, S-corp structures, and accelerated depreciation creates a powerful, multi-layered financial plan. Using these frameworks is not evasion. The government specifically designed and incentivized these behaviors to keep the economy moving. Navigating the tax system effectively requires a shift from the mindset of a passive employee to that of an entrepreneurial entity. The Internal Revenue Code provides a master blueprint that can permanently accelerate the creation of generational wealth.